Hello everyone, welcome to Accounting Buddy PH. Today we will be talking about the generally accepted accounting principles or the GAAP. The generally accepted accounting principles or GAAP are uniform set of accounting rules, procedures, practices, and standards that are followed in preparing the financial statement. So basically, GAAP is somewhat like a law that the accountant should follow whenever they are preparing the financial statements. So we have 6 generally accepted accounting principles that are still applicable for use. We have cost principle, objectivity, materiality, matching, and consistency and adequate disclosure principle. So let's now discuss them one by one. So first we have cost principle. So the cost principle requires that the assets should be recognized at original or acquisition cost. So for example, if X bought a land on September 6, 2018 for 2 million pesos and the value of that land today is 4 million pesos. So what will prevail in the recording of the value of the land is the original cost, which is the 2 million pesos. So the highlight supposedly is in 2 million. So what will prevail again in the recording is the 2 million pesos. The second principle is the objectivity principle. So this principle requires that the accounting records should be based on reliable and verifiable data as evidence of transactions. Okay. So before recording a transaction, you need to check first if there is a reliable and verifiable evidence that supports the transaction. So take note that every recorded transaction must be attached with an evidence or a source document supporting the transaction. So for example, if the business purchased an air conditioning unit for cash, so when recording for that transaction, it should be supported or it should be attached by the official receipt. Now for the third principle, we have materiality principle. So this actually refers to the quantitative threshold. So it deals with the determination whether an item is material or not. So actually, there is no strict or let's say there's no uniform rule when determining for materiality. It generally depends on the professional judgment of the accountant. However, when deciding whether the item is material or not, the accountant has to consider these 2 factors. First is the size of the item in relation to the total which the item belongs. So, for example, the amount of advertising expense to the total selling expenses, or let's say the amount of office salaries to total administrative expenses. Now, another factor that must be considered when determining whether an item is material or not is the nature of the item. So these are those items that are inherently material because by its nature it affects the decision making of the management. So for example, let's say there is a discovery of unliquidated funds of 20,000 pesos. So even for large companies or even for multinational companies, the 20,000 pesos unliquidated funds is very much material. So this is something that must be investigated. It must be corrected so that it would not happen again. Okay, moving on to our fourth principle, which is the matching principle. So this is a combination of the revenue recognition principle and the expense recognition principle. Under the revenue recognition principle, income is recognized or recorded when it is earned. So the question right now is, when can we say that the income is already earned? So normally, income is considered earned at the point of sale because at this point, the ownership is already transferred from the seller to the buyer. And then for expense recognition principle, the expenses are The expenses should be recognized or recorded when it is incurred. So, for example, in our utilities, specifically electric bill. So, the electric consumption for the month of August is normally paid in the next month, approximately on the first week of September. So, when recording this transaction, the expense should be recognized in the month of August. That is because the electricity is consumed during the month of August. So going back to the matching principle, as I said earlier, it is a combination of revenue recognition principle and expense recognition principle. So what exactly is the matching principle? So in matching principle, the revenue or income should be recognized when earned, and corresponding expense should be recognized when incurred during the same period as revenue is earned. So for example, the business sold some of its products to customers. So on the date of the sale, the business will record the revenue or the income earned from that sale. And then in addition to that, all expenses related to the sale of those products should also be recorded. So moving on to the next principle, we have consistency principle. So this principle requires that accounting methods and procedures should be applied in a uniform basis from period to period to achieve comparability in the financial statements. So, meaning to say, if you are applying the certain accounting method in the first year, so it should be continually applied, or the same accounting method should be continually applied for the next years of operation so that you can easily compare the results of business operation from one period against the other period. However, changes of accounting methods may be allowed only if there is a significant change in the nature of the business operation, or if there is a new standard requiring to do so, provided that whatever the reason might be, proper disclosure must be made to the notes to proper disclosure must be made in the notes to financial statements. And we are now in the last principle, the adequate disclosure principle. So here in this principle, it is required that financial statements should be free from any material misstatements, and if there is any, it should be properly disclosed in the notes to financial statements. Okay, so we're now done with the generally accepted accounting principles. I hope you learned something today, or I hope you learned something out from this video. Thanks for watching, guys.